If you're the kind of person who keeps their money in the bank, under the mattress, or in a hole in the backyard, then this video is important for you. Your money is losing value. Sounds scary, right? Oh, but it's not affecting me, surely. It is. It's like a leaky tap that's causing a slow drip on your cash and it's barely noticeable. But the good news is you can do something about it, and I'll be sharing those tips in this video. So make sure to stay to the end of the video so you can fix that leaky tap and hold on to your money. I'm even sharing a few tips to start looking after your money, which may take the edge off some financial stress in your life. So the first tip to start saving your money is to smash that like button for the YouTube algorithm. All jokes aside, it helps the channel out enormously. It helps to promote the video, which means more people see this information, which means maybe we can help them save some more money as well. Thanks for that. Let's get into it. Your money is losing value. I said it at the start of the video and I'll say it again because it's true. This is because of inflation. Inflation is the increase in prices of goods and services across an economy. When prices inflate, you need more money to buy the same things. The opposite of inflation is deflation, when prices lower across a range of goods and services. To measure the inflation rate, you can't just take a regular cup of coffee and measure the change in price from year to year. We've got to look at what's considered a basket of goods and services. In Australia, the inflation rate comes from the Consumer Price Index, or CPI. The CPI takes what the government refers to as a basket of goods and services and measures the change in price from month to month and year to year. They then spit out a number, and that is the rate of inflation as a percentage. One of the benefits of living in a developed country is a certain amount of confidence that inflation rates will stay within a reasonable range. In Australia, for the past 10 years, the average inflation rate was just 1.85%. So it's fairly safe to assume that average inflation rates will continue to hover around the same mark for the next few years. To demonstrate inflation, let's say we have $100. Today, this $100 is worth exactly that. $100. But if we take this $100 10 years into the future, its buying power is dramatically reduced. It's still the same $100, but because of the prices of goods and services creeping up, you won't be able to buy as much with that money. If inflation stays at an average of 1.85% for the next 10 years, you'll need $120 to buy the same things that $100 buys today. So if your income stays the same while prices go up, you'll feel the effects of inflation. Your money won't go as far, and you'll have to make some changes in your budget to stay afloat. If your income goes up each year at the same rate as inflation, your buying power will stay the same. If your income is going up at a greater rate than inflation, your money will go further when buying goods and services. This is what we want. If we are moving forward and our income is growing ahead of inflation, that is a good thing. The bottom line is, if the interest rate on your investments or money in the bank isn't beating inflation, you're losing out. The future will be tougher for you, and you may not be able to afford the same standard of living that you do today. Inflation is a part of living in today's society. It's important to account for it and then plan ahead accordingly. With that said, there's a lot we can do to beat inflation and grow our money instead of seeing it drip away into nothingness. We need to get our money working for us. If you ran a retail store and hired some employees, you're paying for them to be there at the store. If they stood around and did nothing, what would you do? Crack the whip, get them working, sweep the floors, restock the shelves, do something, make you some money. Our money is the same. In my last video, I talked about our money as a worker metaphor. It's up there at the top if you want to learn about it or even refresh the idea. If you've got some money in the bank, sitting around, being lazy, costing you money in bank fees and losing value because of inflation, wouldn't you want to get it working? Now we know about inflation and that our money could just be losing its value by sitting in the bank, I want you to ask yourself these questions. I've got X amount of money in the bank. What am I doing with it? How much is it costing me for it to just sit there, and where am I going to start putting it to work? Just like a business or retail store, we need to manage our money like they are little employees. So we've got some cash. What do we do with it? Step 1, set up an emergency fund. Work out your average monthly expenses. Things like food, rent, electricity, any repayments on any debt that you have, phone bill, gym membership, just to name a few. Now, after you've worked out these expenses, I recommend putting 6 to 9 months worth of those expenses in a high interest savings account. Now remember, we want to beat the inflation rate. So if we're looking at the average of 1.85% over the next 5 to 10 years, we want to find a savings account that will beat that rate. This account should be separate. The Barefoot Investor recommends this. Personally, I don't do it, but if you think you've got itchy fingers and like to spend your money, you should probably do it. This makes your money a little harder to get at, and also when you're looking at your daily use bank account, you're not always seeing your emergency fund bank account. Tempting, I know. Why are we doing this? I know I probably don't have to tell you this, but I will. Shit happens. Cars explode, people die, aliens invade, you buy that new boat on credit, you buy that new Toyota Land Cruiser on credit, you get married, and then unexpectedly, quadruplets. Nah, but seriously, crazy stuff aside, things do happen. A family member or loved one might get sick, they live in another country, that's an expensive visit. You might get injured or sick and have to take some time off work. That costs you money because you're not at work. You might even lose your job because of some unforeseen circumstance. And then there's also some amazing things that you can do when you've got some cash put aside that you don't normally have. You could take some time off work, do a course, learn some new skills, or go on a holiday. You could quit your job, do the same. Or you can even start a business. You could make a whole new career change. Having those 6 to 9 months put aside for a rainy day really helps. It gives you absolute peace of mind that no matter what happens, you can cover the bases. It also gives you a bit of breathing room when otherwise you might be under a lot of stress or pressure. And it doesn't have to be 6 months right away. If you don't have that much money right now, just get a month or two put away. All right, step number 2, pay off that debt. If you don't have any debt, nice one. Maybe go get some so you can come and do the next step with us. Nah, just kidding. Once you've set up the emergency fund, it's time to pay off some debt. Pick the biggest, fattest, highest interest rate debt that you can, and let's pay it off. You might have credit card debt, car loans, or even a mortgage to pay off. Or maybe some debt from a friend or family member. Not actually debt, free money. Paying off debt is almost like investing, but it's better. Let me tell you why. If your debt has a 5% interest rate per annum and you pay it off, it's like you're investing that money at 5% per annum. Because the money you save from not having to pay interest on that loan goes straight back into your pocket. So it's like you're investing that money at 5% per annum. But it's better because you don't have the headache of that debt hanging around. You're not getting updates or emails about that debt. Plus, you also don't have to manage a new investment. Getting rid of debt can free up a lot of space in your mind and get rid of some worries. Taking on a new investment can take a little bit of time and some management. So if you're paying off debt instead of investing, that time is time that you save. Paying off high interest rate debt is a good thing. But Lachlan, I don't have any money to pay off my debt with. I'm like drowning in debt already, man. That's all right. In one of my upcoming videos, I'll be sharing exactly how you can crush your debt so you've got more money in your pocket and less worries on your mind. Step 3, invest the rest. After setting up your 6 to 9 month emergency fund and getting your money working on paying off some of that debt, what do you do with the rest? Invest it. Find an investment with an interest rate that beats the rate of inflation. Better yet, find an investment with an interest rate that absolutely crushes the rate of inflation. I use the Australian Bureau of Statistics website to check inflation rates. There's a whole heap of information there, like tables, graphs, downloads, cryptic statistical map. Actually, you probably don't want to go there. It's pretty boring. In my opinion, if you want to outpace inflation, there's a fair few things that you can invest into. Investments like gold, commodities, and index stocks are easy to get into and can outpace or even crush inflation. Be aware though, as these can also make negative returns. Even renting out a spare room in your house or apartment can increase your income and help you stay ahead of inflation. You could also get creative and rent out your garage. Over all these methods though, gold is often seen as the investment for those who wish to hedge against inflation. My first video goes into more depth on a few investment strategies that can outpace inflation. I'll leave a link to that one in the description. I'll also be going into more depth on buying gold in a future video. The main point I'm trying to get across in this video is that inflation is a real thing. It's there and it's going to be around for the foreseeable future. If we can manage our money, we can actually beat inflation. which means more money in your pocket, a better standard of living for you and your family, and less financial stress in the years to come. Thanks for watching the video. As always, hit the like button if you found something useful. And if you like the kind of content on my channel, make sure you subscribe. I share all things related to wealth creation, passive income, and the mindset required to create financial freedom. Have a fantastic week. I'll see you in the next video.